Deferral, definition, concept, examples. Deferral, accounting concept. Know that accrual-based accounting is the official accounting method followed by companies. For accrual concepts, please see my other video. Link is given in the description. Revenue and expense deferral both stem from the same accounting principles, the revenue recognition and the matching principle. The revenue recognition principle dictates that revenue should be recognized in the period in which it is earned. The matching principle is the reason for expense deferrals. It calls for expenses to be reflected in a company's books during the same accounting period as the revenue they support. Definition. Deferrals are type of adjusting entry in a company's general ledger that delays the recognition of a transaction in company's books until a future period. Deferrals are used to put off revenue and expenses to a future time period. Why? Why do we use deferral accounting? Deferrals accounting is followed by companies as doing so reflects a business's financial activity more accurately and improves the accuracy of financial statements. Deferred revenue. A revenue deferral is an adjusting entry that pushes a company's recognition of revenue to a future fiscal period. This is done when the company receives payment from a customer in advance and actual delivery of goods or services will happen in a future date. We will now see an example for deferred revenue. Let's understand using a prepaid maintenance revenue example. Company received cash advance 6,000 for carrying out 3 months of maintenance services. The advance was received in January month and the maintenance services will start next month from February. So in the January month, we will not record the maintenance revenue transaction as no actual maintenance has been carried out and no sales invoice or bill has been raised to customer. So the advance received transaction will be recorded as deferred revenue account credited by 6,000, cash account debited by 6,000. Actually, we have received cash for sales services actually not provided. So deferred revenue account will be credited. It's a liability account in our balance sheet. The transaction for next 3 months. So in the February month, we actually do maintenance services for the customer. So repair sales account credited by 2,000, deferred revenue is debited by 2,000. Same entries repeat for March and April. So at the end of 3 months, which is February, March and April, the deferred revenue account will become nil. We take another example, deferred expense. Expense deferral is an adjusting entry that pushes the recognition of an expense to a future period. This is done when payment has been made for a product or services in advance before receiving the product or service. Example, deferred expense. Let's understand using a maintenance expense, prepaid maintenance expense. We purchase 3 months of maintenance services costing 1,000 per month and paid advance 3,000 for full 3 months of services in the month of January. The maintenance services will start next month from February. So in the January month, we cannot record the maintenance expense transaction as no actual maintenance has been carried out and no bill has been received. The advance paid transaction will be recorded as deferred expense account debited by 3,000, cash account credited by 3,000. The deferred expense account is an asset account in my balance sheet because it is my own cash but lying with the service provider or vendor. The transactions for next 3 months: in the February month, deferred expense account credited by 1000, repair expense account debited by 1000. So this is the actual expense transaction for the month of February. Same transactions repeat for March and April. At the end of 3 months, deferred expense account will become nil. Please like and subscribe. Give comments. This will motivate me and help me to improve and create more informative content. Happy learning. Thanks for viewing.